I'm curious if you observed the CAPE ratio. This is from obviously our old professor at Yale,
Yes, we do.
Robert Schiller's PE data at Hedgeye. If so, do you feel its present-day usefulness is out of whack given the longevity of the U.S. recovery?
Well, present-day usefulness, the CAPE ratio, for those of you that don't know, are a cyclically adjusted PE, okay? So that's what we're talking about. So as opposed to the PE that you see that Stephanie Link or whoever just stares at the PE and says, well, I think this stock's cheap. That's useless, as you know, as everybody knows. But again, a cyclically adjusted PE says, God forbid, what happens if the cycle slows? What would the earnings number be on the real numbers, okay? So that's never going to be useless. I mean, but it's never just one thing.
Right.
Please read Howard Marks, there's just one thing, because there's never just one thing. So it sounds like you've been doing this for a while, but there are a lot of bad habits that people have. Well, I'm going to sell the market on an expensive CAPE ratio. Well, that sounds fantastic. I mean, it really does, but it's absolutely not going to infect or affect what I do every day. It's interesting. It's noteworthy. It is actually cyclically, obviously relevant when you're at peak earnings. So if you look at slide 68 in the current slide deck, you can see the asymmetry on any cyclically adjusted earnings number is wild right now. This is like, again, I always say that this is not a log chart. But again, stocks, of course, look cheap if you use a really high number on earnings. But what if you use, instead of $160 in earnings, or 155 for that matter, what if you use 125? I mean, let's do FedEx for a second. Because people don't get this until it hits them, wham, just like that. Then wham, wham, wham. Then they're like, well, I don't like fighting in hockey. I don't like body contact, coach. This is what happens, okay? This is what happens to little peewees when they become bantams, because there's body contact. This is what happens to little stock pickers, captain stock picker, when the earnings get guided down. Bang, bang, bang. And if they have a boss, they could get fired. So be careful on that. This is the kind of thing. So if you look at when this number starts to come down, the aggregate S&P 500 earnings number, like the FedEx numbers or the U.S. Steel numbers, again, let's just use a very basic example. And again, I'll just make it up to a degree, but it's within the bound of acceptable error, if you don't mind me doing so. And I'm not going to run around saying, well, I have the perfect FedEx model. Like, if you want that, ask Jim Cramer. He's got every model filed by God in his head, and he knows everything about everything. For me, I'm just little old me. So I'll just tell you that the former FedEx number, earnings expected by Wall Street, was around $20 a share at the peak. $20 per share. So they guide down to like $15 a share. Stock gets hammered. Then they're like, oh, you're saying a chance. Maybe the stock's cheap. If you use 15, it trades at this multiple. Now let's go to $13 a share. Then yesterday they said, it's more like 10 to 12. If you take this number to this number, you have cut the expected earnings number in half. Now, if you were buying it where you thought it was cheap on 15, 13, it's just wrong, right? It's simple math. If you take the earnings number to the real number, or cyclically adjusted for where FedEx earnings will bottom, then you'll buy it when it's cheap, okay? When the cycle is done slowing, FedEx will actually be cheap on the right numbers, okay? Same thing goes with the market. It's actually wildly expensive on the right numbers. And again, I wouldn't start with that. If we have quad 4 and it's wildly expensive, you know what to do. If it's wildly cheap and the numbers are set up to go into quad 1 or 2, accelerate, then you know what you do. You buy, okay? So that's what we want you to be thinking when you think about cyclically adjusted earnings.